Hey there, traders and investors. Todd Gordon here of TradingAnalysis.com and Inside Edge Capital. Hope you guys had a good day. Powell was testifying today and came at us with more hawkish tone. Rates moved up, dollar pushed up. Stocks sold off a little bit, but I don't think it changes anything. I still see the market rallying, and I put together 6 reasons, charts, markets that I think could lead to a rally in the market despite the prevalent bearish sentiment that's out there because the Fed is raising rates. And I used to trade for a foreign exchange hedge fund during the global financial crisis. And the key driver of FX is interest rates. Those are 2 of the major markets out there, the macro markets. So the 4 are equities, fixed income, commodities, and currencies. Sometimes they're all moving together. Sometimes it's just 2 or 3 moving together. Right now, actually a few months ago, all 4 were moving. Commodities are kind of quiet right now. Right now it's all about foreign exchange and fixed income driving the equity markets. And though the last 2 YouTube videos I've done over the last 2 days are really focused on that. So now I want to go a little bit further into why I think the market could rally. We're going to touch on a little bit of that macro that I just mentioned, but then kind of get below the surface a little bit and look at the ingredients that make up the indexes, look at why the indexes are really range bound in here. And if you look at a chart, we're at the same level as we were in early May of 2022. It's now March. We have another 2 months and we're at 1 year in a range, which is pretty unbelievable. So let's dive in and I'll show you what I'm thinking about here. Okay, so to start, more macro, and there's a lot going on in this chart. So let me just explain what's going on here. So we're looking at 3 things. In teal is the S&P 500, and green is the U.S. 10-year yield, and in white is the U.S. dollar index. Okay, what happened in 20, and you can see my cursor, good. So what happened in 20 with the pandemic, into 21 and 22? Well, the first thing we saw was obviously yields, the green, the US 10-year yield dropped, bonds went up, yields went down. The S&P 500 dropped in teal. So what happened is bonds up, yields down, stocks down. The US dollar in white tried to sell off, rallied back, and ultimately sold off. The beginning of this story is right here towards the end of 2019 into 2020. US yields when inflation started to take hold because of 2 things. Big time supply chain shortages, inputs, raw materials were not available because manufacturing and production plants and facilities were shut down. 2, everybody wanted to be Shark Tank and start their own business at home and not work anymore or retire from the workforce. People who were in their 60s said, to hell with this, and we're done with it. So that started the inflation spike. So yields rallied. What happens when inflation comes up, the payments that you get on fixed coupon bond payments, that $100 coupon payment, if it's being inflated 10, 15, 20 years into the future is worth less and less and less. So people don't want to hold bonds in an inflationary environment for that reason. So what happens? Yields started to move up here. The 10-year yield started to move up. Now, back to what I said on the opening, one of the key drivers of foreign exchange, I traded FX, which was really one of the most busy markets during the global financial crisis. The key mover of FX, foreign exchange, is if one country is paying a higher rate of return via their interest rate compared to another one, foreign flows are going to go from that lower yielding country, maybe they'll even borrow at a lower rate, and they'll invest in a different country that has a higher interest rate. That's called the carry trade. So they might sell their local currency, borrow at 1%, invest overseas at 4%, and capture your 3% difference, and provided the exchange rate stays stable. Well, if the proverbial excrement were to hit the fan and volatility will explode, that 3% arbitrage you're getting can be eroded by adverse moves in the underlying currencies. That's a super quick basic lesson as to how the foreign exchange markets work. That's what was happening here. So as our interest rates via the yield here, both short and long term, are moving higher faster in the US relative to the rest of the world said, all right, we'll sell our local currency, buy US dollars, and buy our higher yielding currency or whatever product they want to invest here in the US, real estate, bonds, stocks, crypto, whatever. So that's what happened. So the dollar rallied. Now there's a long-standing relationship. When the US dollar rallies, global stock markets traditionally sell off. And that's what finally happened here in the US. So the S&P and teal started to sell off here. So number one, the chronology was the move that started in yields in 2019 fed into US dollar strength here in mid to late 2020. Then all of a sudden, 6 months later, the stock market finally got the picture that, yep, yields are going up, dollars going up. All right, enough of this. And so many of our large tech stocks are multinationals. So many companies, large market capitalizations in the S&P are multinationals. If they're making money overseas, they got to repatriate, and they're bringing less earnings back overseas over here to the US soil with that stronger dollar. So that chokes off our stock market. Now, what's happening? That's like a 5-year history of macro to arrive at this key point. The 10-year yield is now moving up. Powell's talking very hawkishly, and we're back above. We're right around 4. I think we closed at 3.97, so we're still below 4. So yields are back up at the highs that we haven't seen in long time. Notice where the dollar is in white. Even though we rallied today, the dollar is nowhere near the equivalent high, and you can clearly see green and white is correlated. So the dollar is not responding to this move up in interest rates, and the dollar, I would submit to you, is what really sunk the stock market back here in 2022. It's not so much yields, I think it's more the dollar. The dollar is not rallying to the same extent with a 4% 10-year yield. High is probably 4.2, 4.3, maybe up. Maybe we even got 4.5. I can check it, but we're nowhere near that in the dollar. Okay, and the stock market is now starting to respond higher because of it. So takeaway of this is FX dollar is not responding as we'd expect by being up at these all-time highs, as is the correlated 10-year yield. So FX is saying it's hopeful on the stock market. That's reason number one. Reason number two, we're going to look at some rotation here. We're going to get inside the stock market. Now, there's 11 sectors that make up the S&P 500. 11 sectors that make up the American economy, right? It's technology, communications, consumer discretionary materials, financials, staples, utilities, healthcare, energy, industrials, and I probably forgot one. This is a rotation, and we love looking at this. This is a relative rotation graph. Julius de Kempener came up with this, and we love it. And basically, it follows sector rotation, allows you to quantify sector rotation. And what you see as basically the market rotates. The rotation happens in a clockwise fashion. As you're up here in green, you're leading. This respective sector is outperforming the benchmark, which in this case is the S&P 500. And you could picture the S&P right here at the intersection of the XY axis, right? So, okay, so if we're up here, we're outperforming wherever that sector is. And this guy up here, energy, this guy was ripping. Okay, and each one of these dots represents 1 month. So you're going back 1 month, 2 month, 3 month, 4 month, 5 months, blah, blah, blah. Energy was absolutely ripping. And I've been overweight energy in the wealth management since I launched back in 2021. And now as we're rotating out, I'm taking off that overweight status. What else is rotating out? Utilities is heading lower. Healthcare heading lower. Staples heading lower. Financials heading lower. Materials heading lower. Those are all the value trades. Those are the value trades. Those are the ones that you would run to in times of risk aversion, right? Those are stable, older economy businesses that usually pay a dividend and have less volatility or a beta compared to the market. Those are where you hide out. Well, they were in favor. You can see that they were moving up into the leading quadrant here in 2022, but what's happened? Energy, utilities, staples, healthcare, health, staples, utilities, materials, financials, all rotating out. What is rotating back in? After getting crushed, XLK is technology, growth stocks. XLY, consumer discretionary, growth stocks. XLC, communications. That sector's only been around for 5 years or so. They broke it off from technology, rotating in. So what do you have? You have value trade rotating out, and then the growth trade, which is down here in the lagging quadrant, is starting to rotate back in. Isn't that interesting? Chart number 3, breaking down various market capitalizations. So we like to look at small, medium, and large cap stocks that are growth oriented, and these are ETFs that are focused on growth stocks and are focused on value stocks. This chart really says the same thing, but it breaks it down into market capitalization. So same thing, this is a monthly rotation. What has gone up in the leading and is heading back down to the weakening and is pointing to the lagging quadrant. Top 200 value, large cap value. Mid cap value is already down here in the weakening. And then right here is small cap value, this guy right here. Those guys are all pointed in the wrong direction. What's pointed in the right direction? Large cap growth right here, top 200 Russell growth ETF, this guy right here. Mid cap growth, small cap growth. These guys have made huge moves. The point that I'll also make here at the end of this is growth is coming back into favor, but it's not those fangs that you remember over the last 4 or 5 years. It's the smaller and the medium cap growth stocks that are making the moves in here. Large cap is still on the map, and that's why at the end of this, you'll see that the indexes are sideways, because there is movement and rotation in favor of growth, but it's out of those large cap fangs. It's in the small and medium cap, say $75 to $50 billion market caps and less. Okay, so why is large cap not helping the indexes? The indexes are still range bound. It's because, as I mentioned, the growth sectors, which are communications, XLC, XLY is consumer discretionary, XLK is technology, those guys are rotating in. But the large caps, look how much further and down to the left the big caps are. Tesla, Google, Amazon, Meta. These guys are just getting their butts off the mat. They just got floored. And they're just picking themselves off the mat begrudgingly, trying to shake the cobwebs out a little bit. They're just starting to move up. You look at a chart of Google and Amazon, it looks terrible, right? Meta is starting to come back after getting crushed, as is Tesla. So these guys are helping the index stay supported, but they're not moving up enough to create a new uptrend in the index, which is the S&P and the NASDAQ that you all watch so closely and everyone reports on, right? So you have value, large, medium, and small cap value rotating out, as I showed you in the last screen, and you have large cap growth and tech and communications and consumer discretionary just starting to make the move. And you can see these guys are physically lower on the y-axis than the respective sectors, comms, discretion, and tech. So by definition, these guys are not pushing these sectors higher. It's the small and medium cap stocks that are moving. So again, they're not providing the benchmarks, the S&P, the indexes, a lot of help. Okay. I want to show you one more chart. All that being said, take a look. Now I'm going to flip to Elliott Wave very quickly. Okay, this is the XLK. This is the technology sector ETF. I'm going to get an Elliott Wave real quick. Okay, just the most basic Elliott Wave tutorial I can give you is wherever you see basic 3-wave moves, that is a correction to an ongoing trend. Anytime you see 5-wave moves, which is up, down, up, down, up, anytime you see 5-wave moves, that indicates the direction of the trend. For me, XLK, those of you who have studied Elliott, you can make the case that it's down in A, up in B, down in C, down into late 22, and we just did what they call a diagonal, which is a 5-wave move off the lows. We might be in for a little bit of a correction here at XLK, 135 to 125, but if we hold above 124, I'm quite constructive on XLK. And as I mentioned, small and medium cap growth and tech are doing well. Look at semis, look at NVIDIA, ripping. Look at some of the semis, ASML. I mean, just Lam Research. We have Skyworks. We have a bunch of semis in the portfolio. So if those large cap tech can start to help, XLK will move up. Now, why do you want to look at XLK? The NDX is only about 50% technology. The NASDAQ 100 is only about 50% tech. There's a lot of other sectors in there that, as I mentioned, are rotating out. Right? So I want to focus on pure tech, and I do see evidence of 3 down and 5 up here in XLK, which might suggest that was the low. Final chart. Now, as I mentioned, value is rotating out, hurting the indexes. Large cap growth is starting to help, but not doing very much. We might have a range-bound stock market index for a period of time. This is a little bit more advanced Elliott wave. We've been sitting on this count. No one that I know of in the Elliott wave community is showing this chart. This will get out and people start to circulate it because that's what happens. So it's possible, being that value stocks are rotating out, energy's getting crushed, staples, health, utilities, financials, and several industries within materials are rotating out. Small and medium cap stocks on the growth side are rotating in, as large cap growth is starting to kind of stabilize a little bit. That might leave the index sideways, and this is advanced Elliott wave stuff, but it could be on the S&P daily that it's ABC for W, connector X, and then we're going to slide into a sideways triangle into the summer of 2023, a couple Fibonacci targets, May and July of 2023, complete the triangle, frustrate bulls, frustrate bears, and once that's done, everyone throws their hands in the market, which in my experience, I'm starting to get that sentiment as I'm watching Twitter and talking to everyone. People are getting frustrated, myself included. But usually in my experience, when you're frustrated, when you can't make heads or tails on the upside or downside, you're usually in a triangle. And if that's the case, monitor your emotions, monitor your friends and colleagues' emotions. If we go into this triangle, that's going to give you more conviction that this is the path forward. And as soon as enough people throw their hands up in the air and discuss, is when the market breaks out. All right, guys, hope that helps. Throw a question, comment, insult in there. I'll be sure to address it all. I'm going to go do the member video now, heading to kids ski racing. I'm coaching the kids at our local mountain, and another couple weeks of winter. Hope you guys are doing well. Stay cool, calm, and collected in this range-bound market. There's a lot of cross currents at work. All right. Hope that helps, and I'll see you guys in the next video update.